Imagine walking into a casino where the house quietly hands every new player the same rulebook, but no one bothers to read it. Most people lose money first, then they finally decide to learn the rules. Surprisingly, the stock market works much the same way. For millions of people, their first investment isn't the beginning of learning. It's the tuition fee they unknowingly pay to the market. That might sound unfair. After all, investing is often presented as a simple formula. Buy good companies. Hold for the long term. Let compound interest do the work. But if it were really that easy, why do so many first-time investors panic during market crashes? Chase expensive stocks near their peaks, or sell at exactly the wrong moment? The answer isn't hidden inside balance sheets or complex financial models. It's hidden inside the human mind. History shows a strange pattern. Most successful investors didn't begin by making extraordinary gains. They began by making ordinary mistakes. Some lost a little, others lost fortunes. But nearly all of them discovered that investing isn't just about understanding markets. It's about understanding yourself. Consider the story of Sir Isaac Newton. Today he is remembered as one of history's greatest scientists, the man who explained gravity and transformed physics. Yet in the early 18th century, Newton fell victim to one of the greatest financial bubbles ever recorded, the South Sea Bubble of 1720. At first, he invested, earned a profit, and wisely sold his shares. But then he watched everyone around him continue getting richer. Friends, neighbors, and fellow investors seemed to be making effortless fortunes. Fear of missing out overwhelmed logic. Newton bought back into the market near its peak, only to lose an enormous amount when the bubble collapsed. Later he reportedly remarked that he could calculate the motions of the heavenly bodies, but not the madness of people. That sentence still captures one of the greatest truths about investing. Markets don't simply measure companies. They measure human emotion. Economists once believed investors behaved like perfectly rational decision-makers. But reality told a different story. In the 1970s, psychologists Daniel Kahneman and Amos Tversky transformed economics with what became known as prospect theory. Their research demonstrated something remarkably simple yet profoundly important. People feel the pain of losing money much more intensely than the pleasure of gaining the same amount. Losing $100 hurts more than earning $100 feels good. Imagine carrying two identical backpacks. One contains gold coins you've earned. The other contains rocks representing your losses. Even if both weigh the same, the backpack filled with losses somehow feels heavier. That's how the brain processes financial decisions. This phenomenon is called loss aversion, and it explains countless investing mistakes. Investors hold on to losing stocks because selling would force them to admit they were wrong. Meanwhile, they often sell winning investments too early because locking in a profit feels emotionally satisfying. Ironically, the opposite behavior is often more rewarding over long periods. Then something unexpected happened in the late 20th century. Researchers stopped treating these behaviors as isolated mistakes. They realized they formed predictable patterns. This gave birth to behavioral finance, a field that combined psychology with economics. Suddenly, many market crashes that once appeared mysterious became easier to understand. Take the dot-com bubble of the late 1990s. The internet was genuinely transforming the world. Companies promised revolutionary technologies, and investors believed a new economic era had arrived. Businesses with little revenue and no profits saw their stock prices soar simply because they had .com in their names. Rational analysis slowly disappeared beneath excitement. It wasn't entirely irrational. The internet really did change everything. The mistake wasn't believing in technology. The mistake was believing that any price was justified. When reality finally caught up in 2000, trillions of dollars disappeared. Companies that investors assumed would dominate the future vanished almost overnight. Others survived and eventually became giants. The difference wasn't technology. It was valuation. This distinction often confuses new investors. A great company isn't always a great investment. Imagine buying a beautiful house worth $500,000. If someone forces you to pay $2 million for it, the house hasn't changed. The investment has. Price always matters. Few investors understood this lesson better than Benjamin Graham. During the aftermath of the Wall Street crash of 1929 and the Great Depression, Graham watched fortunes disappear almost overnight. Instead of abandoning investing, he asked a deeper question. Why did intelligent people repeatedly make irrational decisions? His answer became one of investing's most influential ideas: the margin of safety. Rather than paying whatever the market demanded, Graham argued investors should only buy when the price offered protection against uncertainty. It was less about predicting the future and more about preparing for being wrong. One of Graham's students would eventually become the world's most famous investor, Warren Buffett. People often assume Buffett became wealthy because he always knew which stocks would rise. But Buffett has repeatedly admitted that temperament matters more than intelligence. According to him, investing isn't a game where the person with the highest IQ wins. It's a game where emotional discipline consistently beats emotional excitement. That idea seems almost disappointing. We expect success to come from discovering secret formulas or hidden information. Instead, the greatest investors often succeed by doing things that feel emotionally uncomfortable. They buy when others are fearful. They wait while others become impatient. They ignore headlines that convince everyone else to act immediately. History had seen this pattern long before Buffett. In October 1987, global markets suffered what became known as Black Monday. The Dow Jones Industrial Average fell more than 20% in a single day. Newspapers described panic. Television broadcasts showed traders shouting across exchange floors. For many investors, it felt like the financial system itself was collapsing. Yet businesses didn't suddenly lose 1/5 of their factories, customers, or employees overnight. Prices collapsed much faster than underlying value. Investors reacting emotionally amplified the decline. The same story repeated during the global financial crisis of 2008. Fear spread faster than facts. Banks failed. Credit markets froze. Entire industries appeared threatened. Investors who sold purely because everyone else was selling often locked in enormous losses. But those who remained disciplined experienced something remarkable. Markets eventually recovered. They always had after previous crashes, though nobody knew exactly when. This doesn't mean every investment survives every crisis. Many companies disappear forever. The lesson is more subtle. Markets experience emotional extremes because people experience emotional extremes. Even professional investors aren't immune. Studies by researchers such as Richard Thaler showed that cognitive biases influence experts as much as beginners. Experience reduces mistakes, but it doesn't eliminate human nature. Overconfidence is another silent enemy. Imagine learning to drive. After several successful trips, confidence naturally grows. But confidence isn't the same as skill. In investing, a few profitable trades often convince people they've discovered a winning strategy. During bull markets, rising prices reward almost everyone, creating the illusion of expertise. Then conditions change. Suddenly, strategies that seemed brilliant stop working. Investors who borrowed money to amplify gains discover leverage works both ways. Losses accelerate just as quickly as profits once did. This is exactly why legendary investor Charlie Munger frequently emphasized avoiding stupidity before seeking brilliance. Preventing catastrophic mistakes often matters more than chasing extraordinary returns. Consider another psychological trap known as recency bias. Human beings naturally assume recent events will continue indefinitely. After years of rising markets, people begin believing stocks only move upward. After severe crashes, they believe recovery may never come. Neither assumption matches history. Markets move in cycles because economies move in cycles. Businesses expand. Recessions occur. Innovation creates new industries while older ones decline. Every generation experiences events that feel unprecedented, yet many follow patterns remarkably similar to the past. During the oil crisis of the 1970s, investors feared prolonged economic decline. During Japan's asset bubble in the late 1980s, many believed Japanese companies would dominate global business forever. During the housing boom before 2008, countless people assumed real estate prices could never fall nationwide. Each belief contained elements of truth. Each ultimately became dangerously exaggerated. Perhaps the greatest irony in investing is that the market constantly rewards behaviors that feel uncomfortable and punishes behaviors that feel emotionally satisfying. Buying after prices have fallen feels frightening. Selling after huge gains feels impossible. Waiting patiently feels boring. Ignoring sensational headlines feels unnatural, yet these habits repeatedly distinguish disciplined investors from emotional ones. Research from firms that analyze investor behavior has repeatedly found that many investors underperform the very funds they own. How is that possible? Because they buy after strong performance and sell after disappointing periods. The investment itself may perform well over decades, but poorly timed decisions reduce actual returns. Imagine planting an apple tree. Every few weeks you dig it up to check whether the roots are growing. Instead of helping, constant interference prevents healthy growth. Investing often works similarly. Long-term wealth usually requires giving investments time rather than demanding immediate results. This principle becomes even more powerful through compound growth. Albert Einstein is often credited, perhaps incorrectly, with calling compound interest the eighth wonder of the world. Whether he actually said it or not, the underlying idea remains extraordinary. Small, consistent gains accumulated over long periods create results that appear almost magical. But compounding has one strict requirement: time, and time demands patience. This is where most people fail before they ever truly begin investing. They don't lose because markets are impossible to understand. They lose because they expect quick rewards, underestimate emotional pressure, and overestimate their ability to predict short-term movements. Eventually, many discover something unexpected. The market wasn't trying to defeat them. It was exposing habits they never realized they had: impatience, fear, greed, overconfidence, the desire to follow crowds, the reluctance to admit mistakes. Every market cycle becomes a mirror reflecting human behavior. That's why investing is unlike almost any other profession. A surgeon improves primarily by mastering medical techniques. An engineer improves by learning better mathematics. But an investor must master both financial knowledge and personal psychology. One without the other is rarely enough. Perhaps this explains why some of history's greatest investors spend as much time reading philosophy, history, and psychology as they do studying financial statements. Markets are built from numbers, but prices are driven by people. So maybe the first money many investors lose isn't simply a financial loss. Maybe it's the price of replacing confidence with humility, replacing excitement with patience, replacing prediction with preparation. The people who eventually build lasting wealth rarely stop making mistakes altogether. They simply stop repeating the same ones. They begin treating every loss as information rather than failure, every downturn as a test rather than a disaster, and every investment as part of a much longer story. The market has been teaching these lessons for centuries. It taught them during the South Sea bubble. It taught them after 1929. It taught them during the dot-com crash, the financial crisis of 2008, and every major cycle since. The names of the companies change. The technology changes. The headlines change. Human nature rarely does. And perhaps that's the most valuable lesson of all. Successful investing isn't about becoming smarter than everyone else. It's about becoming calmer than your emotions when everyone else loses theirs. The next time markets swing wildly, remember that prices may tell you what people feel today, but they don't always tell you what businesses will become tomorrow. Learning that difference is often the moment someone stops paying tuition to the market and finally begins investing instead. If this story changed the way you think about money, keep exploring the history behind markets, businesses, and investing. The greatest returns often begin not with the next stock you buy, but with the next idea you truly understand.